Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 210, Mortgages with Andy Greenstein. Andy, thank you for joining me on the show.
My pleasure, Jake. Thanks for having me.
Oh, of course. And I'm a little embarrassed. This is my 210th episode, and I don't know why you haven't been on yet. What's taking me so long?
I haven't been invited. Corey had me on his show a few months ago, and I've been waiting for the invitation.
Yeah. Well,
Thanks for having me.
Shame on me, because I've known you for many years. You actually did the mortgage on my house, and that was back in 2015. We probably met even before then. So I've known you for a number of years now, and I'm excited to have you on the show because this is certainly relevant with the housing market starting to shift and interest rates going up quite dramatically compared to where they've been the last few years. I thought it would be perfect timing to have someone on the show that deals in the mortgage arena every day. But before we dive into that, Andy, do you mind sharing with my audience, because again, this is your debut on Upticks, so the millions of people that are going to watch this show, do you mind sharing kind of a little bit of your background, where you grew up, where you went to school, and how you got into the mortgage business?
Absolutely. So I was born in Kansas City and lived in Kansas City till I was about 10. Then moved to South Florida, lived there until my senior year of high school. And my senior year of high school, I moved back to Kansas City. After graduation, went to KU, and then graduated with a degree in economics. And then after that, moved to Chicago and worked at the Mercantile Exchange in the foreign currency floor, on the foreign currency floor. And I didn't really like it. I was there for about 6 months. Didn't really feel like it interested me very much. So decided to get into the mortgage industry. My family's involved in real estate. My dad's a real estate attorney. He owns a title company. So you get a mortgage, you close your mortgage at a title company. So my dad owned a title company since the mid 90s. And he would always tell me the mortgage industry is getting ready to explode. Rates are dropping. And there's a lot of guys doing mortgages out there refinancing. And it's a very, profitable business. You could do well without going to graduate school. And he thought I should look into it. So I did, got into the mortgage industry, and then moved back to Kansas City in 2002. And I've been back ever since, living in Kansas City doing mortgages.
Awesome. So you've been in the mortgage industry for 20 years.
Yeah.
Very cool. Very cool. Good. And now I have a question, because I'm a little confused on this. So are all mortgage lenders the same? Because you hear about people always saying, just shop the rates. But should people just do that? Or is there differences between different companies on the mortgages?
That's a good question. So banks, most people, or a lot of people 10, 20, 30 years ago thought, you want a mortgage, you go to your bank where you have your checking account, you apply for a mortgage, you take their terms, and then you have all your stuff under one roof. Well, not all lenders are created equal. So banks, although they provide mortgages, they make their money through many different channels, right? Commercial loans, savings accounts, investments, insurance, all different types of avenues. With mortgage lenders, mortgage banks, we do one thing. We do mortgages, and that's it. So we have to be very efficient, very effective. We have to have value add in order to stay in business and to be profitable, because we don't make any money from any other avenues like banks. So I would say that although your bank can provide a mortgage, it's important to look around and see where you can get the best deal. Because most times, 9 times out of 10, you'll get a better rate, better terms from a mortgage banker or broker compared to a bank.
Got
your
it.
Standard bank.
Yeah, that makes a lot of sense. So I could see like a bank is kind of like a Walmart where they have everything. And then if you go directly to someone that works at a company that specializes in mortgages, that's all they're doing. So clearly they're going to have a bigger focus or emphasis on that.
Yeah, we have to have a competitive advantage.
Yeah, it makes sense.
And a lot of times banks hold their mortgages and they don't do as much volume. We deal directly with Fannie Mae and Freddie Mac, as a lot of mortgage banks do. And that's essentially the government. So we're pooling billions of dollars in loans. And because of that, most of the time, Guaranteed Rate and other mortgage banks are able to offer more favorable terms.
Right. Got it. Okay. Thank you. Yeah. Thank you for sharing. So speaking of that, so interest rates, hopefully everybody knows this, but rates have been rising pretty dramatically this year. So we're recording this at the end of August here in 2022, but where do current rates stand for a traditional 30-year fixed or 15? Like, what are you seeing as far as the rate standpoint right now?
So currently rates are, as you watch the market, obviously every minute of every day, the 10-year treasury just went above 3% earlier this week or late last week, and it pushed interest rates close to 6% for a 30-year fixed.
Wow.
And to put that in perspective, late in 2021, the 30-year fixed was under 3%. So the first time in my 20-year career, we've seen rates double in less than a 9-month period, which is crazy to think, right?
Yes.
So it's definitely impacted the market, the real estate market. It's definitely impacted people's motivation and the urgency to move and to do things. And to use their mortgage as a vehicle.
Right. Makes a lot of, so if the 30-year mortgage is at 6 and the 10 years around 3, is that typical? So again, so people don't bug their mortgage, specialist. Should they just be tracking the 10 years? So let's say somebody does want to move and they're curious about, I know there's calculators online and all that stuff, but can they just pay attention to is that how mortgage rates are set off the 10-year treasury note? Is that how they use that as a gauge? Or
yeah, the mortgage rates follow the 10-year treasury pretty closely, but also factored in is supply demand. So if a company or Fannie Mae or Freddie Mac has a full pipeline and they want to clear some of it out, maybe they'll raise rates for a week or a periodic amount of time to close stuff off their books. But typically speaking, yeah, mortgage rates follow the 10-year treasury. But as we saw rates drop, we saw during the financial crisis, we saw during COVID, as the 10-year drops, it's not lockstep that the 30-year mortgage drops, because they will increase their margins as banks get busier. So they don't need the business. They'll make a higher profit margin as rates drop, because everybody wants to refinance. And people are buying houses as rates drop, more people.
Yeah, that's interesting. That's fascinating. So there's more that goes. So it's not just a pure rate. It's that they're also trying to be profitable and make money on the margin.
Yeah, exactly. The numbers are that, I don't know, 60% of all mortgages were refinanced during COVID.
Wow.
Yeah, 60% of all eligible mortgages. And if rates were true, as they go up and down in a normal market, the 30-year mortgage should have been under 2%. But mortgage servicers, mortgage lenders, banks padded their profits a little bit more than they typically do because they were so busy. So the 30-year rate, I think the lowest we saw was like 2.5%.
Got it. Which was awesome. Wasn't that unbelievable? I mean, I'm sure you were super busy, but I mean, that's unbelievable to get a 30-year mortgage at 2.5%.
Yeah, absolutely. So the rates were under or close to 3% during the financial crisis. And then 10 years later, essentially, or close to 10 years later for COVID.
Right.
Not good things for most, for all of us, but at least one benefit with a lot of negative going on was people got low interest rates. That was a positive. in a negative time period.
So so speaking of that, we were comparing notes before today's show, and so I wanted you to talk about kind of the state of the market now. So if 60% of all homeowners refinanced during COVID, so where does the market stand now? But maybe you can comment on not only the mortgage market, but what you're selling in real estate, because obviously there's a direct correlation there. But what's the state of the market and where do you think it's headed?
Yeah, so the market, I'd say mortgage originations are down probably, I think the numbers are 60 to 70% from last year.
Oh, wow.
You have to factor in that, a third of all mortgages are refinances typically in a typical market. So 30 to 40% refinances last year, and in 2020, those are off the table. Those people have refinanced. So now it's just a purchase market. And there's a lot less people right now buying houses because A, low supply, B, higher rates. So you're seeing more of a balanced market. The last 2 years, you've got a lot of friends, a lot of clients, you've seen it firsthand. They call you, they want to buy a house, bidding war, they're trying to get their financial plan together with you. And, multiple offers on a house, sold for over list price. Some of your clients have probably paid over list price. So it was a frenzied market. Now you're starting to see more equilibrium, more of a normal market where, you're not having 5+ offers on a house. Maybe there's no offers for a few weeks. Maybe people can get lower than the list price. They don't have to pay over list price. So it's good. We're getting more of a balanced market. One issue in Kansas City that still exists is that there's a limited supply of houses. There's not enough inventory. And part of that is the areas we live in Kansas City, but also it's because builders didn't build enough houses during the downturn over the last 10 years. So you just have population growth. Also,
right.
Baby boomers are also staying in their house longer. They're not retiring. People are living longer. They need housing longer. They're not going to nursing homes at age 70. People are living in their houses till they're in their 80s and 90s.
Right. I actually listened to a good podcast about that. And then also you have millennials finally starting to have families and want homes. So you have these baby boomers retiring in place. The millennials want some supply, but the supply is not opening it up. So, a lot of my clients have asked that have been looking for homes for years. Oh, I think the real estate market's going to crash and everything's going to be really cheap. What do you say to people that are saying that? I mean, do you think it's going to crash?
No,
right.
I don't think it's going to crash because I don't think there's enough. There's too much demand. There's not enough supply. That's number one. Number two, I've been in the business 20+ years. I will say between 2003 leading up to the financial crisis, very, very easy to get a mortgage. Many times you didn't have to verify a job. Many times you didn't have to put any money down. The loans that we're doing now, based upon government lending regulations, people are qualified. People are putting money down. And also with appreciation of homes, if people do struggle financially or they do run into a problem, they can sell their house and they can cash out because they have equity. They're not underwater.
Got it.
Right?
Got it. So that was the big problem of the housing bubbles, that nobody had any equity in their homes. There was no proof of income. And would you argue that there was even maybe oversupply back then too, because there were more home builders in the space?
Yeah.
Yeah.
There was more supply, much more supply compared to population or viable buyers than there is today.
Got it.
And if you don't have equity, you don't have a vested interest, although you'll ruin your credit for a period of time, it's much easier to walk away if you're not leaving money, if you don't have an investment, right?
Yeah, good point. I mean, they dings their credit score horribly, but they didn't lose anything really, other than, and those people probably had a bad credit score maybe to begin with,
Right, for sure.
They shouldn't have been in the house to begin with. So,
yeah.
So if you don't see it crashing, and I know people ask me this all the time, and I get it. You don't have a crystal ball, but so rates are higher, and so now you're seeing homes sit a little longer. There's still, so demand is slowing a little bit, but there's also not an increase in supply. So how does this play out? Do you think, and we're also theoretically in a recession. Some would argue we are, some would argue we aren't. And there's hints that the Fed may even lower rates as early as next year. So what do you think about all this? So what should somebody do, I guess is my point, if they're looking to buy or sell right now? Do they just sit tight? Should they, move forward anyways and get a 6% mortgage? What should they do?
Well, I would say over COVID, with the market being super hot, people were most people were given the advice, you can buy a new house, buy an existing home, and then sell your house after the fact, after you move. Because you have to make what's called a non-contingent offer, meaning you have to close on the new house without considerations of what you're going to do with your current house. You can't wait to sell it. You got to close on the new house. So I'd say right now, I'd be more cautious about going to buy a new house without a contingency, especially if you have a big property, a house over $1 million or something unique on land that would maybe take longer to sell, unless you're prepared for that. Because although, it wasn't very long ago, 3, 4, 5, 6 months ago, the market was out of control. It has slowed down, and you just have to be more cautious because the market in Kansas City is a little unique and different than other parts of the country. In Kansas City, there's not a lot on the market, and houses still, they're still highly desirable areas where they're not making any more land anywhere. But in some of these areas that we talk about, in the areas we live, they're highly desirable. So there's not many houses that come on the market. So there's less, the rates are higher, but it's not affecting everybody. Higher rates are affecting more so first-time home buyers.
Yeah.
Right.
Yeah.
So people that are living in more developed, if you're third or fourth house, I would say you're probably less affected by rates than first-time home buyers are.
Got it.
First-time home buyers in general usually evaluate and say, what's my mortgage payment going to be compared to what am I paying in rent?
Right.
So it's a little different deal, but I would be more cautious. That's what I've always told my clients. A lot of errors and issues were covered up during COVID. People that did renovations on homes that maybe didn't really add value, and they still got their money out because property values are at an all-time high. Or maybe they went and they jumped and they bought a new house and they sold their current house really quickly, right when they needed to. Well, now we're starting to see people that are having a little harder time on some properties sell. It's not as easy.
That's good advice. So rather than just jump in and buy something, assuming that you're going to be able to sell your house very quickly, you want to be careful with that in there. And you talked about bridge loans. Are those still popular now, or you think those are going to be more popular where people have to do that because of that issue?
Yeah, we've always had bridge loans. They've become over time less popular during sometimes, more popular during others. So after the financial crisis, most bridge loan companies just stopped offering them. They've become more popular during COVID with people buying, sold their current house. I think you're going to see a little bit of tightening with banks, with some of their offerings, because like you said, we may or may not be in a recession, but I think most people anticipate slowing down economy as we go into 2023. So banks will get more cautious. They won't offer as many products. They'll tighten some things up, especially on lending. Maybe they won't let somebody borrow up to 90% of their home value or 95% because they'll think maybe that real estate prices are going to level off or maybe drop a little.
Got it.
So I think that they may tighten up a little bit.
Got it. Makes sense. What about the question I get a lot of clients, and we always crunch the numbers for them at Falcon Wealth Advisors, but do you see people get more 15-year mortgages or 30-year mortgages?
Oh, 90% of mortgages are 30-year. I think a 15-year mortgage is great. You save so much interest over time, but people like the lower payment. And a lot of people say, I'll just pay more. Give me a 30-year mortgage. I'll just end up paying more and I'll still pay it off much quicker than 30 years. 9 times out of 10, they don't, right?
Right.
You see it certain ways as well. People get a payment, they pay the payment, they don't pay more than the payment. They pay just what the standard payment is. So it's always good if you can afford it. You don't want to get in a situation where you can't make the payment, or it's really, really, you're not having much extra money left over, or it's really tight. But a 15-year mortgage, because you save interest, is a great move. It's you got to be disciplined. It's a forced savings plan, right?
Right.
It's like the people that you talk to people in the same way. When somebody says, I'm going to put money in an investment, I'm going to add to the investment account every month, and they don't set up automatic withdrawal. They say, I'm just going to manually send you a check or ACH. Do they ever do it? Rarely do they do it.
Yeah,
right?
Exactly.
It's automatic. They do it if they're forced to do it, kind of.
That's good. What about are you seeing a reemergence of adjustable rate mortgages now because rates are higher, or is that becoming more popular?
Yeah. So a lot of people got burnt with ARMs in the financial crisis, and that was one of the things that led to the downturn. So there are still a group of people, and they still kind of have a negative connotation, but ARMs are a good avenue to take because you can save, 100 basis points. So instead of a 30-year fixed, say at 5.5%, an ARM, an adjustable rate mortgage, could be at 4.5%. And a 30-year fixed, as you know, is fixed for 30 years. An ARM can be fixed for 5, 7, or 10 years.
Right.
So especially if it's your forever house, you could take an adjustable rate mortgage, and you always have the ability to refinance down the road. There's no penalty. So when rates drop, you could jump into the 30-year, refinance into a 30-year mortgage 2, 3, 4, 5, 6 years down the road.
Good. Yeah, I would expect those to start picking up. And you're right. I think a lot of people did get burned. So when I even bring it up with clients, they get really tense typically.
Right.
But and I explain the risk. And again, I'm not a mortgage, so it's a little outside my arena. So I always refer to someone like yourself to really go over the risks and the pros and cons with it. But are there any other do's or don'ts for people that you would just kind of throw out there when they're looking at moving or mortgages in general?
I always tell people don't make major changes. So try not to. A lot of times you can't force, you can't help it, but try not to go and switch jobs. Or if you do, check with your mortgage person and ask them what the impact will have on their mortgage application. Because if you go from a salary job to a commission job, that can negatively impact your ability to get a mortgage. Because many times you have to be on a job for a year or 2 years. If you're newly self-employed or you switch to a commission or a variable type income job. That's number one. Number two, don't go buy a bunch of, a new car, open a bunch of credit cards, co-sign on loans for kids. Try not to. Or if you're forced to, or it's kind of something you're going to need to do, check with your mortgage professional, ask the impact. It's always good to ask questions before you take action, right?
Right.
Know the impact before you do something. Because many times you can avoid having a situation that can be a negative. So I'd say number one, just don't make many changes. Number two, evaluate what you want in a new house. Before you dig in and you go look at houses, kind of make a list of non-negotiables, I always say. So if you want a 3-car garage, put that on your list and exclude the houses that don't have a 3-car garage, unless you're willing to add a garage, and then you can look at other things. But a lot of times I've seen clients that start at day one with a list of non-negotiables. They look at different houses and they end up buying a house that doesn't have some of their non-negotiables. And then 2 years later, like, we said we wanted this and this house didn't, and we really should have held tight because now we want to move.
Oh, wow.
And obviously you don't want to move multiple times.
No.
If you don't have to. Moving costs money, right?
Yes. Yeah, it's expensive, and
moving is not cheap.
Right. That's good. I like that, staying firm to your non-negotiables. Particularly if you have a house that you like if you're not in a situation where you have to move, or even if you're renting, just be very specific.
We're seeing a lot of people that were in a rush, and during COVID, as you know, there were multiple offers on a house. You had 2 hours to make a decision. So a lot of people were conceding things, which I understand, it was the market that we were in, but a lot of those people were now saying, are like, man, I didn't have a home inspection, or we kind of conceded on this and that. And a lot of times, sometimes people are like, yeah, we probably should have just stayed in our rental. Should have stayed in our apartment for another year or two and let all this pass over. So sometimes if you have a growing family, you have to move. Or if obviously you're moving states for jobs, things like that, it's unavoidable. But if it is avoidable, or you do have flexibility, it's just good to be cautious and good to think things through, especially as we get into a more stable, normal market, I would say.
Right. What about the pre-retiree? Would you recommend somebody doing this before they retire? You said don't make any big moves. I'm assuming retirement is part of that.
Yeah. So I would say, yeah, if you're thinking about moving or you're wanting to do something financially with your mortgage, check with your mortgage professional, because that can have a negative impact. The programs offered through Fannie Mae and Freddie Mac, which is the government essentially, that insures over 90% of all mortgages, they've over time evolved and opened up the ability to get a mortgage to retirees more than ever. So as you know, for some of your customers, a lot of times people will call me and say, I don't have a standard job. Can I get a mortgage? You can. You just have to have a stream of income, or you have to set it up after retirement. But not everybody has the savings to do that. So a lot of times people get a mortgage or move if they know they're not in their permanent house and they don't have a lot of savings. They'll move when they still have a normal salary because they know they can qualify for a mortgage. And after they retire, they're not going to have the income stream or the sufficient income stream to qualify for the mortgage they want.
Got it. And this may be common sense, but should somebody go visit their mortgage professional before they start shopping for a home? That way they know what they pre-qualify for, so that they're not getting over their skis if they're looking. Is that what you'd recommend?
Yeah, absolutely. Especially now when you have rates that have increased or rates that are moving quickly. Online mortgage calculators are great, but a lot of times they're not real time. A lot of time they're not accurate to what the current market is.
Right.
So you want to make sure. We've seen situations where people have been pre-approved. Pre-approval is usually good for 4 months. Somebody got pre-approved late last year. They're shopping for houses, haven't been able to find a house. And then in March or April, they find a house. Well, rates have gone up 2%. they may not still qualify for what they did late last year.
Wow.
So it's always good to keep your numbers together, because people with incomes, getting raises, maybe going from part-time, full-time to part-time, people's budget change. And with rates moving, you got to touch base with your person, your mortgage professional, to see what rates have done and what the impact is since you got pre-approved.
Yeah, it makes sense.
It's
So someone can go with you. Go ahead.
Go ahead.
Well, someone can work with you and then go and lock in a rate. Is that what you're saying, for 4 months typically? And that rate will be locked in?
So when you apply with the mortgage lender, we look at the credit, and a pre-approval is good for 4 months because the credit report's good for 4 months.
Gotcha.
And then after the 4 months, we would have to go pull a new credit report and extend the pre-approval. We actually came out with a program last year. It's called Lock and Roll, where you can lock in an interest rate for up to 90 days without having a property picked out. So you could lock in a random loan amount. Obviously, you don't know what your final loan amount is until you know what your final purchase price is. But we can lock in a client for up to 90 days, and we can move the loan amount after you find the house. And then we can extend it for 30 days. So you could be locked in for 120 days before you've even looked at a house, or
Nice.
before you've even narrowed your search to a specific part of town. So it's pretty good. Prior to 2021, you'd have to have an exact property address defined before you could lock in a rate.
Interesting. Yeah, it just shows you how much that your industry changes, just like anything else. So that's interesting that they can lock it in for up to 120 days.
Yeah.
Good.
It's a good program, and it helps people that are wanting to move, but the uncertainty with the rate environment, they want a guarantee. They want to know they're locked in,
Right.
And for budgeting purposes.
Yes.
Like we were talking about.
And I forgot to ask this in the beginning, but are you obviously you're licensed in Kansas and Missouri, but can you do mortgages all over the country, or is it just Kansas and Missouri? How does that work?
Yeah, guaranteed rates licensed in all 50 states. So we do loans in all 50 states. I personally am licensed in California, Arizona, Colorado, Texas, Florida, Illinois, Kansas, and Missouri.
Got it. The popular states where people
big
move.
second home areas.
Yes, exactly. That's because I have a lot of clients doing that. I have a lot of clients that have bought second homes in Florida recently. And so that's good to know that they can go, but they live here, so that they can go to someone in Kansas City and not have to worry about developing a relationship with a mortgage person in Florida.
Yeah, the mortgage industry is kind of like your business, right?
Mm-hmm.
You can't be a realtor in Kansas City necessarily and help somebody buy a house in Florida because you don't live there. And most realtors are licensed in just one state, or if you're in Kansas and Missouri. But like our businesses, we can do it from wherever.
Awesome. That's good to know. Well, perfect, Andy. Is there anything else to wrap up our show here that people should know right now in the current mortgage environment? This is very helpful. Thank you.
Like in your business, knowledge is everything, right? Knowledge is key. So ask questions, call your mortgage professional, ask questions, and educate yourself, because the market's changing and you want to be educated before you jump in, right?
Yeah, perfect. That's really good advice. And thank you again. Now, I think it's on your LinkedIn profile, Andy, that you say something to the effect that you can handle complex math problems in your head.
Well, not as much as I used to. I'm pretty good at it. But I did it after, growing up. But now I'm older, Jake. We're old. I mean, I'm 44 years old. Not as good with the math in my head. But that's why we have phones, right?
That's right. But yeah,
so
what could you do? Numbers. Could you do like compound interest in your head?
No. Multiplication, like 2 and 3 numbers.
That's still pretty strong. Yeah, I don't care what age. That's pretty good. I always wanted. I don't think I've ever asked you that, but I love that you have that on there. That makes me want to work with you. It's pretty smart.
Very nice. Very nice.
Well, this guy can do math and complex math in his head. That's pretty cool.
Right, but nowadays I could do something wrong, and then somebody's like, "Wait, my payment's 3 times what you said it was going to be." Well, I was having a bad morning. Sorry about that.
Right. We don't want to have that. We don't want to do that.
Right. No.
All right, good. And just to wrap up our show, Andy, do you have any book recommendations, TV shows, movies, anything that you kind of seen? I know you've got a family as well, but anything fun going on in your life outside of the mortgage world?
Not that. My son's junior in high school. He's starting his football season at China Mission East.
Nice. What position does he play?
He plays defensive back.
Oh, very cool. Very good.
So first, we want him not to get injured, right?
Yes.
And to have a good time.
Yep. Very fun. That'll be good. It's football's kind of getting in the air. Chiefs preseason, fall's kind of coming. So good.
I don't play golf. I know you play a lot of golf. You're a big golfer.
I am. Yeah, I've been playing a lot of golf lately. Finally, the weather I feel like is really, really prime time for golf season. So I've been getting a lot of rounds in lately.
Is fall your favorite time to play golf?
It is. I don't like it when we, whenever we do the time change, I don't like that because I feel like the sun never gets high enough. So I think early fall is probably, like right now, is probably my favorite time of year to play golf, because when the sun never gets high, it just feels weird to me. But anyway, that's just me. But yeah, probably early fall. And I'm weird, Andy. I don't mind actually the summer heat, because I think in my head, and I could be completely wrong, that the golf ball goes a little further because it's so hot. Because in cold weather, it doesn't go as far. So I just think conversely, in hot weather, maybe it goes further. So, and I'm a guy that will take any distance he can get. So if I can hit it a few more yards because it's 100 degrees, I'll go sweat it out because I want to go a little further. So, I'm okay.
Is it true?
I think it is.
Is it a scientific fact?
I probably need to do more research. I mean, it works for me. It makes me feel like it does. So, but
it gives you more confidence.
Yes, exactly. I can tell you this: in cold weather, it definitely goes shorter. I know that for a fact. I mean, I've just growing up, even in West Texas, it got cold in the winter, or here now, when it's 40 degrees, that golf ball does not travel as far. I don't know if it's our muscles are tighter. We don't swing the same, but something happens and it doesn't go as far. So, So anyways, that's what's new with me, though. That's what's going on lately. So, well, thank you again, Andy, for joining me on the show. If anyone that's watching or listening to this needs to get in contact with Andy because they've got mortgage questions, certainly reach out to me. I can direct you to Andy. And thank you again, like I said, and we hope you all have a great week.
Thanks, Jake. Appreciate it.
Yep. Thank you.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.